Okay, so we have, AM Best has a negative outlook on the reinsurance sector. We've had that for 3 years now, and that really reflects the fact that we still see more negative rating actions than positive, and that's really driven by all of the traditional negative pressures, the excess capacity, the low interest rates, the poor economic growth generally across the world. And we see companies now earning returns that are struggling to meet their costs of capital. The losses emerging from recent events are only going to depress that further.
I think that the recent events are going to put pressure on a number of companies to reconsider their raison d'etre, if I can use a French term, to think about whether now is the time to perhaps join forces with other companies, given the increasing importance of scale in the business.
It's an opportunity time for us, frankly. You have large events, but there's also we can do large capital transactions. So big structured transactions are very valuable to large insurance companies, and only big players can do that. And the customization of large transactions is very important in this today's market. Because the general kind of flow traditional business is shrinking. Important for us, but important for them too, because they want to shrink that and have the customized solution that solves their...
Where we see, really simply where we see the market. And Greg from AM Best said, you know, AM Best still have a negative outlook on the sector, more negative actions than positive, low interest rates, excess capacity, low economic value add. He thinks a $75 billion loss from these two events will equate to 106 combined ratio, which isn't really enough to damage the capitalization of the sector. Is that right?
We have 6 for the reinsurance.
Okay, for the reinsurance sector. Yeah. We have our two direct reinsurer friends here who have said, this is an opportunity for smaller companies to leave the market, and only a few people can actually write structured transactions, and this is going to prove that we're going to have a few big direct reinsurers again someday, and won't that be awesome?
From our perspective, things are, pretty positive. We, a lot of our focus is on assuming legacy business. And there's been a lot of action in the marketplace, both onto the large transactions, which we haven't got the balance sheet for, but that has, I think, then really sort of indicated the decision for the smaller and medium-sized guys to, whether it's getting rid of work comp portfolios in the US or getting rid of sort of EL liabilities in the UK, and of course just the advent not only of in the US it's very much a sort of best or rating agency capital model that's driving people to sort of get rid of kind of reserve risk. But of course in Europe it's now Solvency II, which is putting significant charges on on reserves that just didn't exist before.
There is more capital out there than is needed to service demand at the moment, but I think it is serving a purpose in the industry. And it's almost like there's an assumption that just because it's sitting there, reinsurers don't mind if it goes. I don't think that's going to be the case. Actually, I think in a lot of cases it's serving to defend ratings. So actually it is serving a purpose in the industry, and if it starts to be eroded, then that will have implications.
There's a lot of things that have to come together, particularly in poorer countries. The first thing you need is a good regulatory framework, because you can't do private business without a good regulatory framework. So companies like ourselves, and I'm sure Scor, work with these regulators to get them to understand the business and understand how it's best to set up a regulatory. So we can have a private, and sometimes it's the government needs to step in. Christian at our media conference today was mentioning a scheme in Kenya. And you need the government to help out very poor farmers. This is just something that's clear, and it's probably a good long-term solution.
Last year at Monte Carlo, we looked at calendar year quarterly reserve development for the top 20 global P&C companies. This was an arduous exercise. We went all the way back to the 1990s, and we looked at every single 10Q, 10K. We looked at conference call transcripts. We looked at RNS releases. We looked at company presentations for every single quarter for every single one of these 20 companies, and we figured out what the reserve movements were on a calendar year basis or accounting year basis for those companies. And it was actually, at the end of it, it was gratifying because we learned what we thought we knew, which was calendar year follows accident year. And we could see the liability crisis emerging on a calendar year basis after it emerged on an accident year basis in the early 2000s. And then we saw this long period of calendar year redundancies, but it looked like a cosine wave. And as ever, the redundancies are getting smaller in aggregate on average, and we don't know how much longer they'll last, but I'll tell you this, look at the ADC transactions. You're talking about structured transactions. Look how many ADC transactions you've been working on in the last year or 18 months compared to the previous 3 years. There's a lot more of this going on, whether it's for capital relief, but just as often for reserve protection.
Offers or talks about offering the solution, and the corporates look at the way in which those transactions are structured and say, well, actually, we don't necessarily have the solution that we need. And part of that is due to the fact that they silo to some extent. They don't see their 10K reports could be more dynamic than what we are, right? So they tend to be very similar.
Yeah.
And so once you can make that connection between that risk register and the event and the size of the event, and then see what the penetration really is in insurance, that's when something's got to happen.
Yeah.
Because the governments are thinking that that's been picked up by the by the underlying insurance industry. However, maybe the top 100 companies don't need it. They've got balance sheets bigger than.
Working at JLT, being a slightly smaller broker than maybe Benfield, we do work a lot with the specialty side and the retail side. So much more often than I did in my previous life, I go and see corporate clients, whether in Europe or in the United States or in Asia. And just like in the insurance sector, one of the things that the sophisticated big corporates are starting to understand is that insurance is just another form of risk transfer.
Yep.
And the really sophisticated, quoted large, multi-tens of billion-dollar clients, they look at their weighted average cost of risk as opposed to their weighted average cost of capital. So they now put insurance risk transfer up there with the cost of debt and the cost of equity.
On one dimension, we're looking to increase the penetration of insurance. The other dimension is that as that grows, the price drops. Will continue to drop. So I think as an industry we need to come back and actually look at find ways to actually help increase the penetration, because we're in this cycle when we talked about that the events need to be very big to actually do anything. So that whole market turning event aspect, we could come up with some scenarios that would do that, but in reality we're not seeing that at the moment.
I think what Harvey demonstrates actually is that despite I think some great work that gets done by the modelling firms, you often see major cat events that have some unique aspects to them that mean that the model doesn't quite perform as you'd expect. And Harvey is a hurricane, but it's mostly flood damage.
When it comes to commercial, part of it is going to be covered, which is hard to estimate because flood is a risk that is highly sublimited by carriers. So that's where the difficulty lies in to come up with an estimate.
But there is no
Complexities, I would agree, is all the, to kind of your point, that there is the downstream network effects, right? Because there's contingent business interruption claims that are going to arise. Complex risk, because that whole area has a lot of energy facilities. So those are modeled, but again, I wouldn't get to the point where we think, well, the models are insufficient.
1979, Houston suffered 3 1 in 500 year events, right? Now, the thing with this one is imagine a situation where there's very little property damage as such, but lots of liability. And pollution is the interesting one along that shipping canal. There's lots of hazardous sites, chemical plants. If they flood,
Texas.
if they flood, that's an enormous loss. And I don't necessarily see that be modelled. And that's potentially some of your upside, big upside.
Litigation that takes place, although it's highly visible and often annoying, it's a small percentage of the total incurred loss that's being paid out. It gets a lot of attention, and perhaps rightly so,
But as an industry, I would just like to say that most of the incurred losses, including flood, are going to be paid on time and in advance.
I don't think it's going to have a big impact on the ILS market. I think if you look at a lot of the investors, a lot of the backers, I think they had a pretty good idea of what they were buying. I think there may be litigation, but I think that many of those investors are in this space because for them it's an alternative asset. If you look at, say, the big pension funds, they've allocated 0 point something of their asset classes to this. They've had some great returns. They can possibly have one bad year.
On the ILS market, I also don't think the hedge fund guys are dumb enough to make a great big fuss about litigating this thing, because that would just turn people off. And so I think that they will be very cognizant that this is their, in fact, please quote me on this, this is their turn to pay the claims and to behave in an orderly fashion on behalf of our clients. They don't want to do anything besides that during this claims paying process, I don't think.
That area of the market hasn't really been tested, and it's an opportunity for it to prove itself.
Yeah.
And actually, if there aren't that many issues, then I think a lot more buyers are potentially going to be interested in looking at that as a product.
Yeah.
So there's an opportunity for that area of the market actually to grow its position overall, I would suggest.
Yeah.
A couple of years ago to mandate that in the contracts, and the market pushed back on that and said
Yeah,
we're going to mandate payment before the event in order to keep liquid.
Yeah.
And the response was, well, we will do that, for our good clients when and if they need it, but we're not going to take that credit risk of prepaying.
Yeah.
I don't think either the last two cat events that in themselves or even together are significant enough to force structural change. Whether the market learns lessons,
From my point of view, David had it right early on. It's a very well capitalized industry at this point. So to me, unless we get a lot more events, it's going to be, this is just a high cat event year.
Yeah.
Can I disagree with that point?
Sure,
Actually,
okay, sure.
I think it's one thing to look at the supply of capital, and we all agree it's many billions extra. But if you look at what that capital is actually returning on an accident year basis, cat normalized, it's between 3% and 4%. So if the cat bond market, it was down 15% on Friday, it'll probably be back up today. But 15% time, divided by that 4, that's 3 or 4 years of earnings that are wiped out right there.
Yeah.
I think we have to look at the earnings of the industry as well, and when you do that, I think that pricing is going to have to adjust.
So see, that's not, to me, a structural change. That's just a pricing change. See the difference?
It's fair enough,
I don't
yeah,
think
yeah.
we're structuring, to be digital or something all of a sudden, or we have to have a totally different configuration. We'll have alternative capital, we'll have reinsurance, but the pricing may change. Not allowed to say one way or the other. So, but that's just the market, and that's what will roll through this in some sense, right?
Yeah.
I don't think the fundamental dynamic, I don't think is going to change unless capacity is forcibly removed from the market, and that's what hasn't happened. 2011, no companies left the market basically. Until you get into a situation where there is capacity actually leaving the market, I don't think the dynamic really changes.